Hello friends, welcome to digital platform of Dr. APJ Abdul Kalam Technical University Lucknow. Today we will discuss about the unit 4 analysis of financial statement and ratio analysis. Myself Ashok Sen Gupta, Faculty of Management, Institute of Faculty of Management, SMS Lucknow, School of Management Sciences Lucknow. So, before starting this topic, I will just give you a brief what we will learn from that. Financial statement is a statement which gives you the health of any company, which gives the health of the company, which shows the health of the company. In unit 2, you will learn about the accountancy, various accountancy from which are recorded, then summarized in a ledger. So, what is the benefit of doing the accountancy? It is benefit for all the stakeholders, and finally, when we moving towards the end of the year, financial year, the results and output of the company is justified by the financial statement. A good financial statement will justify the company's performance. Financial statement are prepared primarily for decision making. It is a decision making thing. Top level managements having taken the decision regarding the company's policy, implementation of policies, various strategies which need to be established or need to be focused for the benefit of company by the help of financial statement. It is a process to identify strength and weaknesses of the firm. It is a process which identifies the strength and weakness of the firm by using balance sheet, profit and loss account. Balance sheet, profit and loss account are the base of any financial statement. On the basis of this financial statement, we do the financial analysis and find out the strength and weakness of the company. There are various methods to analyzing financial statement, various methods. One of these is comparative statement, second is trend analysis, third is common size statement, next is schedule change in working capital, fund flow and cash flow analysis, cost volume profit analysis and ratio analysis. All are the various tools to analyze of financial state for financial analysis, various tools which are based on the balance sheet and profit and loss account. In the word of Myers, financial statement is largely a study of relationship among the various financial factors in a business as disclosed by the single set of statement and a study of the trend of the factors as shown series of the statements. So, friends, financial statement shows the relationship between two or more financial factors which gives us some output, and on the basis of that output we decide something, we take the decisions. Objective of financial analysis. First objective financial analysis is to assess the earning capacity and profitability of the firm. It is first objective because profitability shows the health, profitability shows how much company earn and how much they are able to provide to the stakeholders, shareholders. Earning capacity increase the functioning, earning capacity shows companies good health, good financial health. To second is to assess the operational efficiency and managerial efficiency. How company managing its overall performance, overall business, effectiveness of the business, operational efficiency, output. Operational efficiency means ratio of output. In if we talk about these manufacturing company, operational efficiency shows how much percentage of the total raw material converted into product, finished good. Managerial efficiency shows the company's solvency, company's liquidity, company's financial activities. Third is to assess the short term and long term solvency position of the company. As we know, most of the companies are depends on external debts. Basically, large manufacturing companies, large companies taking the debt from banks or equity shareholders, debenture holders. With the help of financial analysis, we can find out their solvency position, and according to them, we suggest the remedies. We choose the company to invest if we are the investors. Next is to identify the reason for change in profitability and financial position. In current scenario, in today's world, financing position and the profitability company changes day by day, day to day, or year to year, not day to day, it is year to year. And the changes is sometimes negative, sometimes positive. And company need to focus to maintain the positive growth, positive changes, and find out the solution to come out from the negative growth or slowing down the profitability. Due to the competition and increasing the cost of material, overall profitability decreases, percentage of profitability earning is decreases, but company need to increase it to maintain its shareholders, to maintain the shareholders value, to maintain the shareholders faith, to maintain the stakeholders. That is why they need to analyze the financial positions with the financial statement, financial analysis. Next is to help in decision making control. It is also help in decision making. I already told you, analysis is done by the top management, and they decided how to control. When they have the financial statement in their hand, then they discuss, the brainstorming work is done in boardrooms to find out the proper solution to control the cost. Here we talk about the control. We are talking about the control on the, especially on the cost of the company. Cost can be occurred, basically it is occurred due to the inflation, which increase the cost of the product, due to cost of the raw material. Cost occurred due to the high wages paid by the company. Cost occurred due to the increase in the excise duties or custom duties. So, there are various factors which affect the cost, and company need to control over that cost. Next is provide information for granting credit. company need credit day by day, day to day, for day to day, there is a working credit, working capital credit or working capital loan. Company need loan or credit for capital mobilization or capital formation also, for expanding their business. And this credit granted by the financial institutions to the companies on the basis of financial analysis. They are able to find out the financial health of a company, economic health of the company, and they offer, or you can say they accept the credit request by the companies. Next, objective is to provide, to guide or determine dividend action. All we know what is dividend. Dividend is a payout which company pay from profit to the shareholders. Now, amount and percentage of dividend to be paid is depend on the decision making of the members, board members in annual general meetings, and with the help of financial statement they able to understand the position of the company, and they also able to understand how much payout they can offer to the dividend or shareholders. Ultimately, company needs to increase the wealth of the shareholders to maintain the goodwill. If they are not doing so, if they are not able to, the value of the company, value of the shares decreases. Next is to assess the progress of the firm over time. With the help of trend analysis, we can assess the progress of the firm. We can find out the growth, annual growth. Next, friends, today we will discuss on the one of the financial analysis tool, which is ratio analysis, So, what is ratio? Ratio is a comparison of two numerical values with each other. It is a two numerical values with each other. Ratio analysis is the most powerful tool for financial analysis. It helps the financial statement to making decision making. A ratio is a simple arithmetic expression of the relationship of one number of to another. We all know ratio. We study ratio in our 10th standards. Ratio is just a arithmetic expression which shows the relationship between two numbers. According to Kohler, A ratio is the relation of the amount of A to another B expressed in term of between A and B. So, ratio analysis is one of the powerful tool for financial analysis, and we will discuss this ratio analysis briefly, and we focus on the various ratios in further lectures. So, what we can do, how we can find out the ratios, what are the steps we have to take in to do the ratio analysis. First step is selection of relevant data from the financial statement depend on the objective of the analysis. Most important is what is your objective to find out the financial analysis, what is the reason behind that. There are different objectives of the companies, there are different objectives of the person who is doing the financial analysis. Like somebody try to find out the stocks, somebody try to find out the liquidity position, somebody try to find out the profitability position, solvency position, and so on. So, what is the objective of the analysis is depend on the particular datas which we want to collect for the ratio analysis. Selection of relevant data from the statement, it is our more, we have the statement for ratio analysis. We the important statements for the ratio analysis are balance sheet, cash flow, and profit and loss analysis. You can say trading and profit and loss analysis, trading and profit and loss analysis. Okay. Now, when we choose to a data, it should be relevant and it should match with our objective. Second is calculation of appropriate ratio from data. There are several ratio and we need to calculate the appropriate ratio from by using the formula which we discuss later on for that. Third is compare the present ratio with past ratio, because ratio is a numerical value. Ratio is a numerical value and we compare it. Like profit percentage, like profitability ratio, profit, it is 16%, 17%, but it was in 2019, it was 18%. Then we interpreted that profit increases by 2%, and similar. There are lot of examples, because ratio is just a value, ratio is just a numerical value. So, we can compare with the numerical value, like ratio of boys and girls in a class, in a management class, ratio of boys and girls is, for example, 1.5. That means, if there is 20 girls, then number of boys are 30, the total is 50. We compare it with previous academic session and we find out that the ratio of boys and girls was 2. So, in this year the ratio decreases, in this year the ratio decreases. So, we can do like this one, 2019, 2020 boy and girl, ratio of boys and girl is 2 and here is 1.5, 1.5. Here we can interpret that, ratio of boys and girls has decreases by 0.5%, by 0.5%. So, this is the interpretation. Finally, we need a interpretation after the calculation ratio analysis. If we left after calculation ratio analysis, we can find nothing, is no use until unless we interpreted the result. That is why interpretation and selection of proper data is very important in ratio analysis. Use and significance of ratio analysis. First is help in decision making. We are taking the decision, like in last example, boys and girl ratio decreases, then what we can do? We try to improve it. If the profitability ratio decreases, we try to improve the profitability. Helps in financial forecasting and planning. With the help of ratio analysis, we can forecast, like if increases the ratio of particular, like profitability ratio increases by 2% each and every year, we can forecast it will increase in 2001 by such percentage, like this one. Ni 2019, 2020, 21, 22, if it is moving this one till 20, then we can forecast for the 21 also. You can forecast for the 21 also. Help in coordination. Ratio analysis helps in coordination between the management and the middle level employee, lower level employee. If they find non-satisfactory result with the help of ratio analysis, they talk to the managerial people to implementation, for better implementation of the managerial skill for improving the results. Next is help in control. I already told you, with the help of ratio analysis we can maintain the control over the some cost control areas, cost centers. Utility to creditors. Here creditors are the person who can give us money on credit or raw material. It can also use the ratio analysis to find out the financial position of our company. Utility to the employee. Employee can also find out the position of the company with the help of ratio analysis. Government can use ratio analysis as a tool to understand the company's performance and compare the company's performance with other companies. And last is tax audit requirement. It also for the tax person people who are auditing the tax, like income tax person or CA, chartered accountant. They audit the things, and it is important for them to find out the company's policy and implementation of good policy in the company with the help of ratio analysis. Limitation of ratio analysis. It has also some limitations. Limitations are limited use of single ratio, lack of adequate standards. There are very less ratios which have some set of standards there, because there is no particular standard of any ratio, we can just compare it. Inherent limitation of in accounting, change in accounting procedures, window dressings, personal biasness. Sometimes people change the data to increase the ratios. Ratio not substitution. Ratio analysis is not a substitution, it is a indicator which indicate the position of the company. It is a tool only. And last, clue not conclusion. Ratio analysis give you the clue, it give you an idea where is in about the company's position, as a company's financial position, but it is not conclude the things, how we can do, how can change, how can make it better. It is give you the overview that these are the figures on which we need to work and How we can do it is depend on the companies. Like I again give you an example. If a ratio of A's financial ratio is 13%, if company's A's financial ratio or profitability ratio, you can say profitability ratio is 13%, it suggests nothing. It is just a figure, it is just a value, just a value. But when we compare it, when we analyze it with past year, then we can do the conclusions. Then we can do the conclusions. Okay, this is very less figure or it is good figure for the company according to previous data. So, there are some limitations of the ratio analysis which need to be taken care. So, friends, in this lecture I discussed you about the financial statement. What is financial statement? What are the tools which helps in the financial statements? I also discussed you about the ratio analysis, which is a tool of the financial analysis. There are various tools of financial analysis like horizontal statement, vertical statement, comparative statement, trend analysis, but ratio analysis is a tool. You can refer to this book, Sharma and Gupta Financial Management Theory, for your studies. In my next lecture, we will discuss some ratios with numerical values and how we can use this ratio to find out the objectives, to find out the better objective of the company, to fulfill the. So, friends, thank you for watching this video.